And money supply is growing now. Consumer credit is at all-time high. Household debt, credit card debt, all-time highs. Government borrowing, record highs. In order to fight inflation, you have to raise interest rates high enough to stop all that borrowing. And the Fed didn't do that. They stopped raising much too soon. Rates should have gone a lot higher than they did.
Welcome to a powerful episode with Peter Schiff. What if the current market rally is just an illusion? Japan's market recently plunged 12%, causing a global sell-off. Peter Schiff believes investors are missing the bigger picture. Despite low unemployment numbers, a recession may have been here all year, hidden behind misleading data and persistent inflation. Peter explains why the Federal Reserve is about to cut rates, not because it won against inflation, but because it lost. Stagflation is here to stay, and the market hasn't fully realized its impact. Stay tuned as Peter Schiff reveals why this rally isn't to be trusted, and why overpriced momentum stocks could be a trap. Discover which value stocks might be your best hedge against the coming storm. So, let's start the video.
Well, and obviously the markets were reacting to what happened the night before in Japan. You have, 12% decline in the market like that. Generally, you're going to have a sympathetic sell-off. And I think you had people coming in, just to buy the dip. But I think they're missing the bigger picture. Even before we've been having a rotation kind of quietly, and it's accelerated last week out of momentum type stocks into value stocks. Probably been going on for a couple of weeks, and I think that's because investors had started to correctly price out a soft landing. I mean, the recession. We've probably been in a recession all year. We've just been in denial. They try to hang their hat on the low unemployment numbers, which are a fiction. Even if you take the government's own U6 number, it's 7.8. That's what we got on Friday. That's a high number. Remember, up until 1994, the only unemployment rate we used was U6. And if you look at unemployment for the 52 years from 1994 going backwards to 1942, there wasn't a single year where unemployment ended as high as it is right now. So we have a lot of unemployment. Now we have a lot of inflation. The economy is in a lot of trouble, and it's going to get worse. And so I think the market is starting to price that in earnings. But what they're not pricing in is the resurgence of inflation, because that's coming too. The Fed is going to be cutting rates. Maybe it'll wait till September. Maybe it won't. But it's going to be cutting rates not because it won the fight against inflation, but because it lost, and because it has to prop up the economy, prop up the government, prop up the debt bubble. And so stagflation is here for the duration, and it's going to get a lot worse. And I think the markets haven't priced that in. I think this rally we're getting today, this turnaround Tuesday, is not a rally that I would trust. In fact, if you're looking for a bigger bounce, it would have been better if we had a big decline this morning that took out Friday's low, and then we rallied later in the day. I think this is just a good opportunity to sell these overpriced momentum stocks into the rally and keep buying the value names that I think will do well in stagflation. And remember, stocks do provide a hedge against inflation, just not really expensive stocks. They benefit from low interest rates and low inflation. But when real rates fall but inflation picks up, that's not good for those stocks. You want to own companies that produce products that people buy all the time because they need them. They don't buy them if they can afford them, because a lot of Americans aren't going to be able to afford things. I mean, inflation is wiping out their purchasing power, and they're broke. They have little savings, and I am expecting a major dollar decline, especially when the Fed starts to cut rates and when it goes back to QE. Because what the markets are completely missing is that the next time the Fed cuts rates, I think you're going to see a backup in the long rates. So I think the yield curve is going to steepen, and I think long-term interest rates are going to actually rise, and that's going to confound the Fed and create a bigger problem, because then you're going to get upward pressure on mortgage rates, not downward pressure. And I think the Fed is going to be reluctantly forced, or maybe not even reluctantly, to go back to the QE well and print a lot more money to try to buy up the bonds that nobody wants to hold in order to keep long-term yields from rising. And of course, that's just going to kill the dollar, send commodities soaring, and that's going to show up in the price indexes. Yeah, well, because everybody is making a mistake. They're expecting the bond market to rally the way it did when the Fed started the last couple of easing cycles, or even when it did QE. But when the Fed was easing in the past, it was doing so when inflation was below 2%, and they were able to use that as a cover. But when they start easing, and even more, important, when they relaunch quantitative easing, when inflation is well north of that 2% target, that's a whole different ballgame. And I think everybody has already crowded into the trade. Everybody has anticipated the rally in bonds, and so we've already had it. And so when the Fed actually cuts, I think that's going to be, a sell signal, and people are going to be selling the fact after having already bought the rumor. But as inflation picks up, bonds hate inflation. So high inflation destroys the value of bonds. It destroys the value of the income that you get, and it destroys the value of the principal that you hopefully eventually get. So I think we're, the bear market in bonds, which really started in 2020, that was like the peak of the bull market that really started in the early 1980s. It was a major, major bull market in bonds. I think we're now still early in a major bear market in bonds. And so bonds are going to get killed, and rates are going much higher. And when the Fed eases, that's probably going to be the catalyst to start the next leg down in bonds and up in long-term rates. Now, the Fed gets no credit. First of all, they lit the fire, so I'm not going to give them credit for partially putting it out. But it was more a function of the rise we got in the dollar early on, the pullback in commodity prices. The Fed never really cut back on credit growth. And money supply is growing now, but credit, consumer credit is at all-time high, household debt, credit card debt, all-time highs, government borrowing, record highs. In order to fight inflation, you have to raise interest rates high enough to stop all that borrowing. And the Fed didn't do that. They stopped raising much too soon. Rates should have gone a lot higher than they did. So the Fed basically surrendered its battle against inflation because it was too afraid of the collateral damage in the economy and in the financial markets. And the fact that inflation has come down from 9 to 3, it's more likely to go back to 9 than down to 2. And in fact, it's not going to stop at 9. And when it's 9, it's really 18 because the government probably reports about half the inflation that they create. But what's going to be so much different about this recession that we're in, and that's going to get worse, is unlike past recessions, it's going to be accompanied by rising long-term interest rates and high inflation. Okay. And that's what's going to make the recession much worse. And the Fed's stimulus isn't going to work. It's actually going to turn into a sedative because higher inflation and more upward pressure on longer term rates is just going to take a bad recession and make it a depression.
Thank you for joining this enlightening episode with Peter Schiff. Understanding these market shifts and economic challenges is vital for your financial strategy. If you found this episode valuable, give us a thumbs up and subscribe for more insights. Share your thoughts and questions in the comments. We're eager to hear from you. Stay informed, stay prepared, and we'll see you in the next episode.